Hello everyone and welcome to this Finance for Engineer course. In last lecture we have discussed about the accounting cycle and then started our discussion concerned with accounting principles where we have discussed that the accounting principles are nothing but the rule of action expected to be followed by the accountant, and it is to assure that the information is not influenced by the personal bias or judgment of the people who are presenting this financial information, and also it is supported by the fact. We have seen that the accounting principles have classified into two: accounting concept and accounting convention. As we understood that the main objective of accounting principles is to maintain uniformity and consistency in accounting records. These accounting concepts provide a basis for accounting. All the concepts have been developed over the years from experience, and thus they are universally accepted rules. Following are the various accounting concepts, that is going concern concept, business entity concept, money measurement concept, cost concept, dual aspect concept, realization concept, accrual concept, accounting period concept, and matching concept. Next is accounting convention. These are nothing but the customs or traditions which guide the accountant while preparing the financial statements or accounting statements. They are consistency, disclosure, conservatism, and materiality. Now let us start with accounting concept, and the first accounting concept is going concern concept. According to this concept, it is assumed that the business will exist for a long time and its affairs would be operated with no intention of the owner to close down the business in the near future. So, it is on this concept that a clear distinction made between the asset and expenditure. It assumes that the business shall continue for a longer period of time, an indefinite period. Transactions are recorded in the bookkeeping in view the going concern aspect of the business unit. On account of this concept, the fixed assets are shown in the balance sheet at a diminishing balance method, that is going concern value. There is no need to show assets at market value because these have been purchased for use in future and they earn revenues and are for sale purpose. The concept also suggests distinction between expenditure that will provide benefit over a long period. Due to this concept, assets are valued at cost and depreciated every year. Also, expenses and income are classified into capital and revenue. Next concept is business entity concept. According to this concept, business and its owners are separate entities. Normally, it is very important to understand that a business and owner are two separate people, two separate entities. Accounts are prepared to give information about the business and not about those who own it. Therefore, a distinction is made between business transactions and personal transactions. If there is no such difference, the affairs of the business will be sometimes combined with the private affairs of the proprietor, and the true and fair view of business may not be seen or may not be available. Therefore, the owner is treated as the creditor of the company to the extent of capital contributed by him. The private transactions of the owner will be recorded separately and will have no bearing on the business transaction. This concept keeps the personal affairs of the owner always away from the business affairs. Concept is money measurement concept. As per this concept, only those transactions which can be expressed in terms of money can be recorded. Money here is specified tender currency of the country, which is accepted as a mode of settlement of different transactions among the people. Measuring unit for money is the currency of the ruling country. That is, in India, transactions are expressed in terms of rupees. Transactions and events which cannot be expressed in terms of money, even if they affect the business, are not recorded in the book. For example, death of director, disputes within the organization, strikes, etc., may affect the working and profit of the business but are not recorded in books of account. Now, the next concept is cost concept. According to this concept, the value at which the various assets shall be recorded in the books shall be historical or acquisition cost. According to this concept, an asset is recorded in the book at the price at which it was acquired, that is, at its cost price, which includes cost of acquisition, transportation, and installation. There is difference in meaning of cost and value. It must be remembered that as the real worth of asset changes from time to time, it does not mean that the value of such asset is wrongly recorded in the books. The book value of the assets are recorded do not reflect their real value. As per this concept, the assets shall be recorded at cost at the time of its purchase and its value shall be reduced systematically by charging depreciation. This concept helps to keep the statement free from personal bias or judgment. The idea that the transaction should be recorded at cost rather than at a subjective value. The next is dual aspect concept. Dual aspect is the foundation of accounting. It provides the very basis of recording business transactions in the books of accounts. This concept assumes that every transaction has two aspects showing a dual effect, of which one is considered as debit and the other as credit. Therefore, the transactions should be recorded at two places with the two aspects. For example, goods sold for cash has two aspects. First is giving of goods and the second is receiving of cash. And we have to record these two aspects into the books of account. Due to these two aspects, the total amount debited is always equal to the total amount credited. That is, total assets are equal to total liabilities. This concept is generally expressed in terms of a fundamental accounting equation, which is expressed as asset is equal to liability plus capital. This accounting equation states that the assets of a business are always equal to the claims of owners and outsiders, which are the internal and external liabilities of the business enterprise. Now, the next concept is realization concept. This concept is all about the revenue from any business transaction, which says that it should be included in the accounting record only when it is realized. That is, revenue is recognized only when sale is made. This concept says that any change in the value of an asset is to be recorded only when business realizes it. This concept prevents business firms from inflating their profits by showing expected income which have not yet materialized. Realization means creation of legal right to receive money. Selling goods is realization, whereas receiving order is not. So this is very important aspect. One should understand concern with realization concept. Next concept is accrual concept. According to this concept, the revenue is recognized when it becomes receivable. The revenues become receivable when realized as per the realization concept which we have discussed earlier. Similarly, the expenses are considered to be recognized when these become due for payment. Both the transactions are to be recorded in the accounting period to which these revenues and expenses relate. Therefore, the accrual concept makes a distinction between receipt of cash and the right to receive cash as regards revenue and actual payment of cash, and obligation to pay cash as regards expenses. Every transaction and event affect one or more or all the three aspects, that is asset, liability, and a capital. For example, a firm sells goods for rupees 1 lakh in January 2018 and the payment is not received until 31st March 2018 and the amount is accrued and payable to the firm by the customer on the date of sale, that is January 2018. This transaction must get recorded in the revenue for the year ending on 31st March 2018 because though we have not received money, the transaction has already happened. So it, it says that we should mention it when it has happened. Next concept is accounting period concept. This concept is also known as concept of periodicity. According to this principle, the life of an enterprise is broken into smaller periods, that is 1 year, which is known as accounting period. Because as per going concern assumption, what we have assumed that the life of the business to be indefinite and for measuring profit or loss or for studying financial position of the business enterprise, we cannot wait for a longer period of time. So to make it easy, normally uh, after certain time interval, the businessman is required to review all the operations of the business, and these intervals is known as accounting period. It may be of 1 year, 6 months, 3 months as per the requirement, but usually 1 year is taken as one accounting period, which may be a calendar year or a financial year. The year that begins from 1st January and ends on 31st December is known as calendar year. The year which begins from 1st April and ends on 31st March of the following year is known as financial year. The main objective of the concept is to know the performance of the enterprise at regular intervals, and this accounting period is an interval of time at the end of which the income or revenue statement and balance sheet are prepared in order to show the results of the operations, which discloses the profit or loss made by the business during the accounting period and the financial position of the business on the last day of the accounting period. Now, the last accounting concept, it is last but not the least, it is equally important concept, that is matching concept or revenue match concept. The aim of business is to earn profit, and in order to ascertain the profit, the costs are matched to revenue. As per this concept, expenses of a period should be matched with the revenue of that period. It says the cost incurred to earn the revenue should be recognized as expense in the period when revenue is recognized. Matching principle requires that all revenues earned during an accounting year, whether received or not, and all costs incurred, whether paid or not, have to be taken into account while preparing profit or loss account. In the same manner, all amounts received or paid during the current year but pertaining to previous year or next year should be excluded from current year's revenue and cost. The term matching means appropriate association of related revenues and costs. The difference between income from sales and cost of producing the good will be the profit. The matching concept states that profit or losses made by the business during a period can be measured only when the revenue earned during the period is compared with expenditure incurred for earning that revenue. So these are the all 9 accounting concepts that help an accountant while writing the books of account. Now, next point of discussion is accounting convention, which are the customs or traditions which guide the accountant while preparing the account. And the first convention, accounting convention, is consistency. This convention states that the accounting practices followed by a business enterprise should be continued without change from one period to another. For example, if depreciation is charged on fixed assets according to diminishing balance method or written down value method, it should be done year after year. This is necessary for the purpose of comparison. This convention helps in comparison of financial statements. It also does not mean that accounting principles once adopted can never be changed, but they can be changed if the change is desirable and the change and its effect should be stated clearly. Change can be possible if an accounting principle or method in the new version will in some way improve the reported financial results. In case any change is required, it is to be documented with full evidence accompanying the financial statement. That means the readers of company's financial statement can presume that the same rules and measurements were followed in all the years being reported. If a change is made to a more preferred accounting method, the effects of the change must be clearly disclosed. Next is disclosure. This is also known as the full disclosure principle. According to this convention, all significant information should be fully and fairly disclosed in the financial statements. This disclosure of all significant information is one of the important accounting conventions. It implies that accounts should be prepared in such a way that all the material information clearly disclosed to the readers of the books. The term disclosure does not imply that all information that anyone could desire is to be included in accounting statement, but it says that all significant information should be disclosed. Ensuring this convention increases the relevance and reliability of financial statements. The Companies Act make ample provision for disclosure of essential information. The idea behind this convention is that anybody who wants to study, read the financial statement should not be misled on information about events that are likely to have a material impact on the entity's financial position or financial results. The disclosures can be in the way of footnotes. So, this is a very significant convention which helps the accountant while preparing the financial statements. Next convention is conservatism. The concept of conservatism states that we should not anticipate a profit but should provide for all possible losses while preparing financial statements. It enables the financial statements to show a realistic picture of the state of affairs of the enterprise. This convention understates the assets and overestimates the liabilities. Financial statements are usually drawn up on a conservative basis. Choice between two methods of valuing an asset, the accountant should choose a method which leads to lesser value. This convention ensures that uncertainties and risks inherent in business transactions should be given a proper consideration. If there is a possibility of loss, it should be taken into account at the earliest. On the other hand, a prospect of profit should be ignored up to the time it does not materialize. The rule anticipate no profit but provide for all possible losses is followed in accounting by all the accountants. Therefore, on account of this convention, the inventory is valued at cost or market price whichever is less. This principle or a convention is only a guideline to the accountant and the person entering the entries or transactions into the books of account can use best judgment to evaluate the situation and can record transactions in relation to the information available at that particular time. And the last convention here is materiality. According to this convention, accountant should record only those items which are material and ignore all insignificant items. An item is said to be material if it is likely to influence the decision of the users like investors, etc. Judgment of materiality depends from organization to organization and on the basis of professional experience and judgment. The accountant should attach important material details and should ignore insignificant immaterial details. Therefore, keeping the convention of materiality in view, unimportant items are either left out or merged with other items or shown as footnotes. So here we have completed discussion concerned with accounting principles which contain accounting concepts and accounting conventions. We will continue the next part in the next lecture. Thank you.